Hi, this is going to be strange to lecture this way, but this is what we have to do now. Remember that chapters 1 through 6 were your most difficult, and from now on all we're doing is adding accounts and adding more journals. Chapter 7 is really long. It's like 52 slides long. I don't plan on going through all 52, but I'm going to go through most of it, and then I plan on another recording of just helping you through your chapter 7 homework. Okay, so let's look at chapter 7. This time we're going to talk about accounts receivable. The next chapter is going to be chapter 8, where we talk about accounts payable. A couple things about this chapter is now we're switching over from everything that we've learned has been for a service company, and now we are going to deal with actual merchandise, which changes everything. It changes, returning merchandise and inventory and all kinds of accounts now that we have to deal with that we didn't have to deal with before. Okay, so let's just start at the beginning. We're talking now about a retail business, and that's why the PowerPoint is talking about a retail business. But let's look at the types of journal that are going to be new to us that we've never done before. All we know at this point is the general journal. Now we have to add in a sales journal, a purchase journal, a cash receipts journal, and a cash payment journal. So in addition to the one that we've been using through chapter 1 through 6, we now have to add in 4 more other journals. Each one has their own purpose, which you can see on the slide, and you can also go ahead and follow along with your PowerPoint on the website. Okay, you'll see here that we also have a new ledger. We've only been dealing with the general ledger. Now we're going to also have an accounts receivable ledger that gives every single account receivable customer has their own ledger now. Where before we just lumped all the accounts receivable into one ledger, now we're actually dividing it into 2. One lump sum and then a subsidiary one for each customer. We're going to do the same thing next chapter with accounts payable. So we have 4 more journals, and we have 2 more kinds of ledgers that we're going to deal with this chapter. So it gets a bit tight. So check it out. We've got also now all these accounts we haven't dealt with before. A new asset, that's going to be our merchandise that we're actually selling. A new liability, that's going to be our sales tax payable, because now we need to tax our customers because we're selling retail. Instead of fees income, we now have sales instead of fees income, and now we have also sales returns and allowances for anybody that returns anything. We also have a new purchase, freight in, purchase discount, purchase returns category as well to deal with our merchandise purchases. These are all new things we didn't have to deal with before, but it's pretty easy. Again, we're just adding accounts to the things we've already known. Okay, so let's take a look at doing a journal and ledger entry. So right now, if we were to just use the general journal and we were to sell something on accounts receivable, we would have like 4 different people. We'd have the same transaction, accounts receivable, sales tax payable, and sales, 4 different times going through the general journal, which is an awful lot to post. This is why we're going to start using a sales journal and an accounts receivable journal. Otherwise, it's just repetitive information, same thing over and over and over. That's 4 postings to the general journal, 4 postings to the sales tax payable, and 4 postings to the sales category. It's just too much. Okay, so if I was to do all 12 postings, I would have to go into accounts receivable ledger, put it in there, then I'd have to go to sales tax payable and put it in there, then I'd have to go to sales and put it in there. And it's a duplicate effort. It's just an awful lot of posting when there are easier ways to do this. So what we do instead is we will start using what's called a sales journal. This is a typical transaction, and let's see how it gets put into a sales journal. This is what a sales journal looks like. It's different from the general journal because it has 3 columns now: an accounts receivable, and a sales tax credit, and a sales credit. So we're going to put the total amount of whatever transaction we do in our accounts receivable, and then we have to divide up how much we have to pay in sales tax and how much is actually money for us. But instead of recording all these separately, we're only going to take the summary of the sales journal and post it into accounts receivable. You'll see. So let's take a look at how that's going to work. Here it says, instead of summary postings, with the sales journal, it's not necessary to post each credit sale individually to the general ledger accounts. Gosh, that would take us forever. Can you imagine? If you had 100 customers a day, you'd have to put 100 posts at the general ledger account. Instead, we're going to make one big transaction at the end of the month. So let's look here. We have a sales journal. We put each individual transaction in. And then what we're going to do is just take the total, here 6,156, and just post it once into accounts receivable. And that's it. Just one post. However, we do have another journal, a ledger, and that's the accounts receivable ledger for each customer. And that's different. Each customer's thing under their name will be posted in that ledger. I know, it's a lot. It's confusing. We'll get through it. What's the advantage of a sales journal? Saving time and effort and recording space. Makes journalizing more efficient. And you'll see as we go through. But now we have the accounts receivable ledger, and it's a little bit different. As we post, we're going to post as if we just had a sale. That's what the S1 is for sales journal page 1. The rest of it looks pretty much the same. And now we're going to post from the sales journal to the customer accounts and the accounts receivable subsidiary ledger. So you've got the accounts receivable ledger, but then it has its own subsidiary, which is each individual customer's account. So for example, in the sales journal, the first person, Anne, now goes into her own subsidiary journal with her name on the top and her balance and what she owes. Okay, so normally you would think that if somebody returns something, you would throw it in the sales journal and just take it out of the sales journal, but not necessarily. Instead, we have a separate account called Sales Return and Allowances. It's actually a contra revenue account, and any recordings that deal with sales returns actually go in the general journal. So what does that mean? That means if anybody returns anything, it's called a sales return, or if something's wrong with the goods or services, or the goods actually, it's a sales allowance. So instead of debiting sales, we make a whole new account here called Sales Return and Allowances. It's a new account. It's a contra revenue, which means it's the opposite of revenue, which means it's always going to have a debit balance because revenue always has a credit balance. Okay, so here's an example. Let's see if we can go through. In this example, for example, let's see. The check indicates amount was posted to the customer's account. That's your account number. We would update a CM, means credit memo. J1 is your general journal 1. S1 is your sales journal. And the actual revenue changes because once somebody has returned something or you allowed for damaged goods to be returned, obviously then you've made less money, and so in this example you just subtract it out for your real sales, your real net sales. We're about halfway through, which is cool. We're at slide 35 out of 52. And I know I'm talking fast, but once we do some problems, I think you'll get it. Okay, so let's take a look at everything we've got going here. What they're trying to tell us next is that we have a separate accounts receivable journal, and then we have a subsidiary. And we're going to take the total from our accounts receivable and just post it one time at the end of the month into the accounts receivable account. Got to make sure, though, every month they're the same. That when you add up each individual customer, it totals the same as when you put it in the general ledger. Now they're going to talk to you a little bit about trade discounts and cash discounts. In other words, sometimes you give a discount to a customer if they pay within 10 days, or if they pay, or you just want to offer a discount for that month in particular. So let's say you were selling goods for $1,500 and the trade discount is 40%. Basically, you just take 40% of $1,500 and that's what your value is of something that you're selling. It's simple. We're going to do a few problems. It'll probably be a lot easier once we actually do it than to look at these charts. Okay. They talk to you a lot about credit sales. Basically what we need to know is how to record a credit sale. So they get their own ledger account, or they're written a little bit different in the sales journal. Like, for example, this says American Express and this says MasterCard. And these are payments from a credit company. Finally, the last thing they want you to know is how to record sales tax. Basically, they give you the sales tax. At the end of the year, you need to pay the government the sales tax on the merchandise that you sold. And that's why we have a sales tax payable column. And you'll see that basically we're going to take this amount down here, and it should equal what we file on our tax return. So let's just go ahead and do some problems, and then we'll know a little bit more about what we're doing for this chapter. Okay, I'm going to pause while I pull up your homework. Thanks.